Welcome back, traders. Get ready, because today we are tearing into the absolute most important concept in the financial markets, and that is volatility. If you've ever watched a stock price swing wildly in a matter of minutes, well, you've seen volatility in action. It's the beating heart of the market. Now, for the unprepared, it's a source of absolute terror. But for the professional, it's the ultimate source of opportunity. In this explainer, we're going to completely break down the mechanics, the math, and the mindset you need to master these market swings.
Okay, let's dive right in. Here's our roadmap for this explainer. First, what is volatility? Second, historical versus implied volatility. Third, the fear index, VIX. Fourth, option edge, IV and IVP. Fifth, psychology, surviving market swings. And finally, number 6, inflation and the big picture.
Look, be honest and think about this for a second. Have you ever bought a call option, watched the stock price go exactly where you predicted, but somehow still watched your option premium just bleed out and lose your money? Yeah, it's literally one of the most frustrating experiences for any trader. But here's the thing, it's not bad luck, it's just a misunderstanding of the core engine that actually drives options pricing.
So, Section 1. What is volatility? The extreme ride versus the easy slide. In the absolute simplest terms, volatility is just the up and down movement of the market. But mathematically speaking, it measures the dispersion of a stock's returns over a specific period. Now, high volatility, that brings uncertainty. It completely terrifies everyday retail investors. But remember this, as an option trader, high volatility brings massive profit potential, assuming you're actually willing to embrace the risk. High volatility is an extreme, thrilling ride. Low volatility is a slow, easy slide. You have to know which one you're strapping into.
To actually put a number on this, we use standard deviation, which is expressed as an annualized percentage. Let's look at a real-world contrast to make sense of this. When a company like Zomato first went public, the price discovery was totally wild. Its annualized volatility could hit a staggering 100.95%. I mean, that is extreme fluctuation. Compare that to a super stable, established stock like ABB, which might just sit there at a calm 2.26% volatility. These are two totally different beasts requiring two completely different trading approaches.
Moving on to Section 2. Historical versus implied volatility. Past data versus future expectations.
To really master options, you've got to realize there are two types of volatility. First, you have historical volatility, or HV, which just looks backward. It's an easy calculation based strictly on past stock prices and historical returns. But here is the secret to professional trading. Option traders don't live in the past. We live in the future. And that brings us to implied volatility, or IV. This is the actual volatility that market participants are expecting to see moving forward.
Here is the golden rule, folks. When the market expects a big move, IV rises, and option premiums become incredibly expensive. IV is basically a measurable variable of fear and expectation. Think about it. When an upcoming event looms, like a national election, a budget announcement, maybe a huge earnings report, uncertainty spikes. Option sellers get really nervous, so they demand way more money to take on that risk. The result? IV shoots up and premiums get bloated. If you're buying options in that environment, you are paying a massive premium just for that uncertainty.
All right, Section 3. The fear index, VIX, measuring market uncertainty. The India VIX is the market's ultimate gauge of fear for the next 30 days. So let's say the VIX is currently sitting at 19.06%. What does that actually mean for you? Well, mathematically, it means that over the next year there's a 68% probability, which is one standard deviation, that the market is going to fluctuate 19.06% either higher or lower from its current price. It essentially gives you a mathematical boundary for the market's expected chaos.
And there's a really vital relationship you absolutely need to memorize here: negative correlation. Generally speaking, when the market index, like the Nifty, steadily grinds higher, the VIX cracks and drops. Markets are calm, everybody is happy. But when the market crashes, panic sets in instantly. Traders rush in to buy put options to hedge their portfolios, and that massive demand shoots the VIX sky high. Buying options when the VIX is already peaking means you are paying absolute top dollar for someone else's fear.
Section 4. Option edge, IV and IVP. Finding cheap versus expensive options.
Now, what's really interesting is how we solve a major blind spot with this data. A raw IV number like 14 or 40 honestly doesn't tell us much on its own. Is it high? Is it low? To figure that out, we use implied volatility percentile, or IVP. IVP compares the current IV to the range it's traded in over the entire last 52 weeks. So if the IV is 14, but the IVP is 86, that means for 86% of the last year, the volatility was lower than it is today. You're currently sitting in a high volatility, expensive environment.
How you trade has to change entirely based on this data. If IVP is low, say under 20, the market is probably range-bound, and options are cheap. As a buyer, this is your prime time to hunt for explosive breakouts, because option sellers have basically zero price buffer to protect them. But if IVP is high, like above 80, expect wild, zigzag movements. The premiums are bloated. You have to be surgical here. Get in, catch the momentum, and exit immediately at resistance, or your premium is just going to melt into nothing.
Which brings us to Section 5, Psychology, Surviving Market Swings, and Managing Your Emotions and Risk.
Listen, the market genuinely does not care about your feelings. To survive these swings, professionals use a strict mechanical playbook. Step 1. When your trade hits a 1-to-1 risk-reward ratio or you reach 50% of your target. Step 2. You book half your profit immediately, no questions asked. This secures your capital and instantly settles your nerves. And Step 3. If the market breaks your setup and moves against you, you stop the trade entirely. No revenge trading, no blindly hoping it turns around. You cut it, period.
And let me tell you, this discipline is never more critical than on expiry day. We've got a real scenario drawn from our sources that highlights this perfectly. A trader is sitting on a brilliant 2.23 lakh profit for the week. Fantastic, right? But they take one more trade on expiry day, looking for a breakout. It fails. A single, massive red candle drops. And because of the rapid decay of the options time value, what we call theta decay, that beautiful profit turns into a 39,000 rupee loss in a matter of minutes. If you get greedy on expiry, volatility will take the whole shebang.
Burn this quote right into your brain. Your goal isn't to be right every time. In a highly volatile environment, you are going to take losses. It's totally unavoidable. A pro trader might lose a lakh on a bad day, sure, but they have the ruthless discipline to ensure their winning days hit 3 or 4 locks. Surviving volatility requires making absolutely sure your winning trades completely dwarf your planned, controlled losses.
Finally, Section 6, Inflation and the Big Picture, Long-Term Wealth Building.
Let's zoom out from the intraday charts for a second. The huge hidden risk everyone faces, even if you literally never trade a single option, is inflation. Inflation is a termite eating your money. Governments constantly print currency, so the value of your cash drops. That 10 lakh dream car you're saving up for today, in 5 years, because of inflation, that exact same car might cost 15 lakhs. If you just leave your cash sitting in a bank account or a basic fixed deposit, your purchasing power is melting away because the interest just doesn't outpace real inflation.
So how do you actually fight back? Well, you basically have 2 main avenues. Short-term active trading, like options, obviously carries a high risk level. It requires intense focus on price action and yields fast profits or fast losses. But for the core foundation of your wealth, there's index investing. It's a low-risk, passive approach using rupee cost averaging. You consistently buy the market index, totally ignoring short-term volatility, and that leads to massive long-term compounding.
If you want a foolproof mathematical plan for index investing, just look at the 15-15-15 rule. If you invest 15,000 rupees every single month consistently for 15 years into an index fund that averages a 15% return, you will accumulate over 1 crore rupees. It's really that simple. It doesn't matter if the market is super volatile today or tomorrow. Over time, rupee cost averaging smooths out all those bumps and captures the inherent unstoppable growth of the economy.
So, we've covered the extreme adrenaline of options trading and the steady, unbreakable math of index compounding. But the one thing you simply cannot afford to do is nothing. The money sitting in your pocket is literally decreasing in value every single week. Understanding volatility gives you the ultimate power to protect and grow your capital. So the question is, are you ready to step up and beat the market? Or are you just going to stand by and let inflation win? The choice is entirely yours. Thanks for joining me on this explainer, and keep learning.